Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. If you've just joined us from part 1, you've already got a good understanding of AI funds. Now, in part 2, we'll explore the top AI funds for 2025, the potential returns, and how to assess the risks before investing. Here's how these issues hit fund performance. Regulation delays. Bans on facial recognition in some cities hurt firms like Clearview AI. Ethical pivots. Google's AI ethics controversies slowed product launches, impacting stock growth. Public backlash. Scandals, like deepfake misuse, can spark sell-offs even for unrelated AI stocks. This doesn't mean AI funds are bad. It just means they're part of a young, fast-changing industry. Watching these trends helps you spot long-term winners versus short-term risks. How to choose the right AI fund. Picking the right AI fund isn't about chasing hype. It's about finding the right mix of growth potential and stability. With so many options out there, knowing what to look for can save you from costly mistakes. Focus on these key areas to make a smart choice. Analyzing fund performance. Past performance doesn't guarantee future results, but it's a useful starting point. Here's what to check. Historical returns. Compare the fund's 1-year, 3-year, and 5-year returns. A fund that outperforms its peers in both up and down markets shows resilience. Benchmark comparisons. See how the fund stacks up against broader tech indexes like NASDAQ 100 or AI-specific benchmarks. Consistently beating the benchmark is a good sign. Risk-adjusted returns. Look at metrics like the Sharpe ratio, which measures if higher returns come with excessive risk. A ratio above 1 is solid. Below 0.5 suggests weak risk management. Watch for red flags like sudden drops in performance without a clear industry-wide cause. It could mean poor stock selection. Evaluating the management team. A fund's success often hinges on its managers. In AI investing, technical expertise matters just as much as financial savvy. Check backgrounds. Look for teams with direct experience in AI, machine learning, or tech investing. Many top AI fund managers have engineering degrees or worked at tech firms before moving to finance. Track record. See how long the team has been running the fund. Managers who've navigated multiple market cycles, like the 2022 tech slump, prove they can handle volatility. Transparency. Do they explain their investment choices clearly? Regular updates on holdings and strategy show confidence in their approach. Don't overlook smaller funds with niche expertise. Sometimes a focused team beats a big-name fund with generic tech holdings. Keeping costs in check. Expense ratios eat into returns, especially over time. Here's how to manage costs. Compare fees. AI ETFs often charge 0.40% to 0.75% higher than broad market funds, but reasonable for a specialized focus. Avoid anything above 1% unless it offers unique access to private AI startups. Watch trading costs. Some funds frequently rebalance, leading to hidden fees. Check turnover rates. Under 30% is ideal. Consider tax efficiency. ETFs are usually better than mutual funds for taxable accounts due to lower capital gains distributions. Understanding the investment strategy. Not all AI funds are created equal. Some focus on mega-cap tech, while others target early-stage innovators. Ask. What's their focus? Funds like Batiz lean toward robotics and automation, while others prioritize software, like IRBO. Match the fund's focus to your goals. How do they pick stocks? Some use strict quantitative screens, while others rely on expert analysis. The latter often adapts faster to industry shifts. Geographic balance. Most AI funds are US heavy, but global options, like Robo, offer exposure to leaders in Asia and Europe. A clear, repeatable strategy beats a fund that jumps on every trend without rationale. Top AI funds to consider in 2023. If you want to invest in AI without picking individual stocks, AI-focused funds are your best bet. They spread risk across multiple companies and often target the fastest-growing parts of the sector. Here's a breakdown of the top ETFs and venture capital funds to watch this year. AI-focused ETFs. ETFs offer easy, low-cost exposure to AI stocks. These three stand out for their performance and focus. Global X Robotics and Artificial Intelligence ETF, BATIS, holds 43 stocks, blending robotics and AI leaders like NVIDIA and Intuitive Surgical. Expense ratio 0.69%, up 28% year to date as of 2023, outperforming many tech ETFs. ARK Autonomous Tech and Robotics ETF, RKQ, focuses on disruptive tech, including AI-centric companies such as Tesla and UiPath. Actively managed, so fees are higher, 0.75%. Volatile but solid long-term growth, with a 5-year return of 102%. iShares Robotics and AI ETF, IRBO. Broad exposure to 114 global AI and robotic stocks, including smaller innovators. Lower expense ratio, 0.47%, than peers. Less concentrated than bots, reducing reliance on a few big names. Venture capital AI funds. Venture capital funds back early-stage AI companies before they hit the stock market. These funds are high risk, but offer massive upside if they pick winners. Lux Capital focuses on AI in healthcare, defense, and enterprise. Early backer of successful exits like Zoox, acquired by Amazon. Minimum investment. Typically 1M+, but some feeder funds allow smaller commitments. AI Fund by Andrew Ng. Led by Coursera co-founder and AI pioneer Andrew Ng. Targets AI-first startups in sectors like education and manufacturing. Raised $170 in 2023, with portfolio companies like Landing AI. Sequoia Capital. A tech investing giant with AI bets like Firefly, autonomous trucks, and Scale AI. Looks for founders with deep technical expertise, not just buzzwords. Recent $500 fund dedicated to seed-stage AI startups. VC funds aren't for everyone. They're illiquid and require patience. But for investors who can handle the risk, they offer a chance to bet on the next OpenAI before it goes public. The key is matching your strategy to your risk tolerance. ETFs provide stability, while VC funds chase explosive but uncertain growth. Either way, AI's momentum makes these funds worth a closer look. AI funds give you a stake in one of the biggest tech shifts of our time, but they're not without risks. The sector's rapid growth attracts investors, yet market swings and regulatory hurdles mean it's not a set-and-forget play. Choosing the right fund, whether a diversified ETF or a high-potential VC option, depends on your risk tolerance and long-term goals. Before diving in, take a closer look at fees, management strategy, and how the fund fits into your broader portfolio. If you're unsure, start small or talk to a financial advisor to align your investment with your comfort level. AI is changing the game, and with the right approach, you can be part of it. Still on the fence? Research a few funds and track their performance for a month. Sometimes the best move is watching before jumping. This video could be your first step. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.